The next thing that I want to mention, and by heart, I am an indexer. I have a bond background, 20-something years in the bond industry. On the institutional side, my clients have been Fidelity and Franklin and State Street and some of the largest bond buyers in the country. On the equity side, on the stock side, I gravitate towards indexes, meaning...
Wait a minute.
Uh-oh.
I'm sure this. How are you going to beat the market with just doing indexes? I mean, I'm reading all the time these guys who do way better than these indexes.
Yes,
so
absolutely.
Why buy mediocrity? What's
Yes.
the point?
It's a good question. A lot of people will come out and say, I've beaten the S&P 500 by 4%, 400 basis points. And you look at their portfolio and you see that it's not really a large cap stock, that for the risk they have taken and the volatility they have accepted, if you were to create an index of that same risk and that same volatility, capitalization, volatility, chances are, and on a mid-cap money manager, chances are 76% of those managers did not beat the index. Now, this is not any original thought. I follow the University of Chicago, Fama and French, which you, of course you knew. I'm an indexer at heart. I compare it to people flipping a coin. If we were to line 10 people up on the stage here, and each person were to flip a coin, invariably, some of us would flip a head 2 or 3 times, or 4 times, or 5 times in a row. And if we were to chase returns, which is what I call chasing the hot money manager of the year, if we were to chase returns, we'd all flock over to the guy that flipped 4 heads in a row and say, well, this is our guy. But as you know, the next time he flips a coin, he may flip heads, he may flip tails. The active money managers, the guys that are in there buying and selling the stocks and the mutual funds, are running up costs within the mutual fund. It does cost to trade stocks. They are creating tax consequence for a lot of the people that have these mutual funds. And they're
Wait. So
Yes.
what? They're costing some money. They're not going to have their yachts aren't going to be that big. So what do I care? You know, as long as they're making me the money, they're flipping a lot of stocks.
Absolutely. So let me ask, if a person were to make you, say you start here and end here, what is your preferred path to get from here to here? The preferred path is probably like this. Now, what if you took a path like this? So you've achieved the same return from here to here, but you have accepted extra volatility. The market is efficient enough that if you want to accept that sort of volatility, then you really should get this sort of return. 28% of the large cap managers out there beat the S&P 500 during any one year that are actually running large caps mutual funds. 24% of the mid caps do, and only 14% of the small cap managers do. New York Times had an interesting article in 2008, and it was from Fama and French research. They said that the longer you go in time, the fewer and fewer managers end up beating the index. So if you look at a 1-year time period, the average is about, they say, 14% of the mutual fund managers out there beat the index. That's a 1-year time period. If you stretch it out to 30, it's fewer than 1% of the mutual fund managers. So I would say, as boring as it sounds, because admittedly it is more exciting to buy a stock and have it go up and then at the next cocktail party say, oh my gosh, I bought Google and it went up 20% and now I'm out and I'm buying whatever. If you want excitement, I say, have some mad money. For true portfolio management, buy the low-cost indices. You'll beat 75 to 80% of the managers out there. Your costs will be absolutely minimal. Vanguard, dimensional funds offer some terrific index funds. And buy some bonds on the other side, on the on the fixed income side of the portfolio. Are there, go ahead.
Why is it that long-term bonds seem to have more fluctuation in terms of value than a shorter-term bond? Because it seems always counterintuitive to me that you have a long-term bond, you think, well, it's way out there, shouldn't that be kind of stable at a higher rate, so you're locking your money up, or the bonds are longer-term. But in fact, in practice, it seems like a longer-term bond fund has a lot more fluctuation in it than I'd say an intermediate bond fund.
If interest rates change, say they go from 5% to 10%, a bond that is due in a year will change very little in price to reflect a 5% to a 10% yield change. Now, this is going to get a little bit hairy. A long-term bond that goes from a 5% to a 10% yield may drop 25% in value, where the short-term bond, the one-year CD, one-year bond, that goes from a 5% yield to a 10% yield, may only drop 1 point in value.
Maybe also, maybe think of it as longer-term interest rates are harder to predict, so there's more volatility. We know what interest rates are going to do over the next 6 or 12 months, or we have a very good idea, so they're not as volatile as short-term bonds are not as volatile as long-term bonds because there's more predictability, possibly.
Yeah, absolutely, absolutely. And as long as we're on that subject, the shape of the yield curve, maybe you buy a one-year bond and it gives you 3% and a two-year bond gives you 6%. We'd say, gosh, it's very steep. I go from 3% to 6% in just a year. At some point, the bond yield curve tends to flatten out in most cases. And so it really doesn't behoove you to say, I'll tie my money up for 15 years rather than 10, because the yield on a 10-year bond might be the same as the yield on a 15-year bond. So why not retain the accessibility to your money in 10 years rather than 15 if you're only getting paid the same rate of return?